Welcome back. You're watching Traders Corner, and joining me to delve into what the charts are suggesting this week is Garth McKenzie, editor and founder of Traders Corner. Garth, thanks so much for your time today.
Yeah, hi Bronwyn, thanks very much.
So when we spoke last week, we looked at the S&P 500 chart. So let's start there again, because all indications were that we were entering bearish territory. So this week's chart, does it show that we are in fact there?
Well, it does. I think the basic premise of what I spoke about last week remains, and it will remain for quite some time, I think. This is a weekly chart of the S&P 500 that I'm showing here now. So every candlestick pattern that you see on this graph represents 1 week worth of trade, and it goes back to the middle of 2017 here. Now you can see throughout 2018 it was quite a volatile year, but particularly in the back half of the year, we saw that very, very violent sell-off from October all the way into late December, where the S&P 500 sold off 20% during that time. It was pretty much a 600-point drop from the peak to the trough.
Yes, I think we were calling it Red October.
Yeah, Red October, and then pretty much Red December as well.
Yeah.
But what's happened subsequently is it has actually bounced quite sharply. And if you look, it's from that 2350 level, which was the bottom just before Christmas, it's now rallied 13% off those lows in about 4 weeks. So it's been a very powerful rally, but something to always keep in mind is that these sort of rallies generally always happen in a bear market. You'll extremely seldom see a rally of that sort of magnitude in a bull market. Usually the analogy goes that the bull climbs up the stairs and the bear falls out the window, and then you get these massive big bounces that can be caused by short squeezes and what have you. So it seems as though that's what we've had over the last couple of weeks. Now the thing is, it's getting into interesting territory, because there you can see what I've introduced there, the Fibonacci retracement level. So what I do there is I measure that drop from October all the way to the low point in December, and then I measure the retracements up from there. So your 50% retracement comes in at about 2650, and your 61.8% retracement is at around about 2720. You can also see that the downtrend through all those recent highs comes in at around about 2700 there and thereabouts as well. And the other important thing was what I mentioned last week on the show, was the fact that this 50-week moving average has begun to point to the downside now. And that, for me, has always been a very reliable indicator of whether we're in a bull market or a bear market. When it points up, you can still say we're in a bull market. When it starts to point down, generally that is indicative of a bearish market environment. And what we've seen at the start of prior bear markets is you get this big crack like we've seen, and then you get a throwback to retest the underside of the 50-week moving average, and then it falls back down again. So, you know, I still suspect that if we get up into that area around 2700, we could probably see a bit of a reversal in the market, possibly coming off a bit, especially after the fact that we've had such a big bounce off the lows. Now, if we just take that one step further, now look at the daily chart of the S&P 500, and this is really over 5 months that we're looking at here, so it's a much shorter time frame that we're looking at here. But there you can see the downtrend coming in, and you can see the significance of that 2700 resistance zone up there. And what's also quite interesting for me is the fact that we gapped up on Friday night on the S&P 500, and I've pointed out the gaps there with those black arrows. When you get a gap like that, it's often, particularly after a big rally, that can be interpreted as an exhaustion gap. And certainly the prior 2 gaps that we saw up in November, early November, and then again right at the very end of November, those exhaustion gaps did mark the end of an up move and the start of another leg to the downside. So I'm interested that it gapped up on Friday evening, and as we sit here now, US futures are in negative territory, so we're poised for a slightly weaker open when Wall Street opens today, and we'll see whether the market actually does begin to pull off and come back down a little bit from these levels. Also notable is the fact that we've got this rising wedge pattern that has been forming over the last 3 weeks. That is typically a bearish continuation pattern. And if you see a break down below the bottom of that rising wedge structure, then it probably points to some further weakness. Whether or not it goes all the way back to the prior lows is debatable. I mean, I've seen some commentators suggesting that that is possible. I don't know, but I think certainly some sort of maybe a retracement back down towards 2500 wouldn't surprise me in the least bit. And the last thing I want to point out on this chart is the fact that we've got negative reverse divergence here. What that means is that your stochastic oscillator is now making a higher high, yet the price action made a lower high over the same time period. And that is often quite a bearish indication and often precedes a move to the downside. So for me, all things are sort of starting to signal caution at this point in time. And I'm of the view that the risk to reward ratio of lining up some shorts here probably is quite decent. And that might very well be something that I'll look to do in some form or another, potentially to put on some shorts on the S&P 500 in the week ahead, depending on how the trading activity unfolds here.
Okay, so we're a little bit cautious on the global front. On the local front, we are seeing a little bit of positivity come through. We had the top 40 future breaking above that 48,000 level. So what are you seeing there?
Yes, the 48,000 level's been important on this top 40 future. This is now the March All-Z future that we track here.
Yeah.
And what you can see on the right-hand side of the chart here is what sort of appears to be a bit of an ascending triangle. And the break above 48,100 actually validated that triangle pattern. And it does potentially point to a move up towards 49,000. Having said that, though, it's now still struggling to actually get back into that sort of zone above 48,100. So I don't know. I mean, for the time being, I think we still give the bias to the bulls here. But it's really grinding. I mean, you can see over the last 6 or 7 trading days, it's just been choppy. I mean, whilst the direction is up, it hasn't been much fun trying to trade that on an intraday basis because there hasn't been a huge amount of gusto pushing this market upwards. But if we do manage to get out through that 48,100 area, then the dotted line up there at 49,000 would be the next significant area of resistance, which we would then target. And from there, we then see whether it consolidates and comes back a bit.
Okay, so given all that you've detailed now on the global and the local front, we're not going to execute any trades this week, but you are keeping a close eye on 2 stocks, local stocks. The first one being Pioneer Foods. I had a look at the chart, a little bit earlier, and it does seem to be quite cheap at the moment. It remains quite weak despite that little uptick that you said that we're having. It's around about 81 Rand right now, which is quite far off the 200 Rand high it reached in 2015. And you're seeing further downside, right? So there's a possible short for us on Pioneer.
Yeah, and this is based really on technicals as I see it. The chart has been, or this stock has been significant underperformer recently. Whilst the broader market has managed to move up over the last couple of weeks, this stock has really not done much. It's been pretty disappointing. And if you look at the technicals here, you can see the downtrend is still very much intact. It seems to be stuck below the 50-day moving average here. That's that red line on the chart over there. Since the beginning of January, it's basically been stuck below the 50-day moving average. Yesterday, it began to break below a small area of support, which is at about 82 Rand. And that, to me, suggests that the path of least resistance is probably more to the downside here, I would think. It's not a big mover. You can see over the last 2 months nearly, it's just chopped around. But when I look at that chart, just to me, it kind of says it looks as if it's going back down to retest those prior lows at about 75 Rand. So I think in this sort of area, it does look like a potential short opportunity. If it got out back above 85 Rand, then I would have to say that I'm wrong on that. But as I see it right now, it looks weak. It looks to me like it could still dribble lower. Do keep in mind the stock is fairly illiquid. When I say that, I mean it trades between 100,000 and 200,000 shares a day. Some days it can do more than that, and some days it does a bit less. So it's not a hugely active trader. But nevertheless, if I just look at that technical setup, the way it looks, the fact that it's been underperforming, the fact that it seems to be stuck under the 50-day moving average, my sense is that we've got the potential for another leg to the downside coming here. And if you're patient, I think you could probably look for a short here that ultimately heads down towards 75 Rand a share.
Another short you're looking into, or possible short at least, is Kumba Iron Ore.
Yeah, here's Kumba Iron Ore. So here is also a fairly weak chart. Look, it has made a nice counter trend bounce over the last 2 months since the beginning of December, but that to me looks like a rising wedge pattern that's busy forming over there. Also notice how your 200-day moving average has provided resistance on a number of occasions, back then in November, twice, and again now recently it failed at the underside of that 200-day moving average. What it looks like to me is it could probably break to the downside and head lower. What I want to just look at here, in addition to that daily chart that we've just looked at, is an hourly chart. So here is a chart that every candlestick pattern here represents 1 hour worth of trading activity. And what I see here is quite a neat head and shoulders pattern. And if it starts to break down below this 275 Rand neckline, then that would signal a bearish break to me, and that would project down to about 265 Rand on the chart. So one could, if you're quick and you're watching the screens carefully and it does begin to break down below 275, then I think you could short that. And as long as it doesn't go back above 280, you'll probably be okay on a short there.
Okay, so we're keeping a close eye on both Pioneer and Kumba, but just remind us how much is sitting in our kitty for this year, seeing as we are sitting on our hands this week?
Yeah, we haven't done anything, so it's still all cashed up at the moment. We started the year with 150,000 Rand in our local portfolio and 15,000 US dollars in our offshore portfolio. So this is the part of the year now where I still need to start putting some runs on the board and make sure I don't go out for a duck. So we keep looking out for some trading opportunities and we'll execute them when we see something that looks worthwhile doing.
And certainly, considering the markets picture you've sketched, it's going to be a rather interesting year.
I think it is. I think this is going to be a year kind of like last year where it's going to be a bit volatile, it's going to be a bit choppy. I'm seeing lots of commentary which suggests that we're probably moving into a low return environment now. Look, arguably we've been in a low return environment on the JSE for 5 years, but I'm talking globally now, where we're moving into a low return environment. And it's a very different type of environment. So one does need to adapt your trading strategy accordingly.
You talk about adapting your trading strategy, and that leads us quite nicely because you've got some courses coming up. So if anyone does want to attend that and maybe adapt their strategy, can you give us some insight into how viewers can contact you?
Yes, so I'm running a series of courses throughout the country now in the next couple of weeks, in Joburg on the 9th of February, in Cape Town on the 16th of February, and in Durban on the 9th of March. If anybody's interested in attending this, it's my high probability trading course. I've been running it for 6 years and I've gradually adapted it over the years as it's always a work in progress, I suppose. But anyone that's interested in attending, please email me, garth@traderscorner.co.za, and I'll send you all the information.
And then if our viewers haven't already done so, just remind us again how they can sign up to our free weekly newsletter as well.
Yes, if you go to traderscorner.co.za, you look in the middle of the page, you'll see there's a link there for a free weekly email. Register there. It's quick, simple, take you 30 seconds to enter your details, and then what we'll do is send you an email every Tuesday detailing what is coming up on the show each week.
Garth, thanks so much for your time today.
Thanks.
Garth McKenzie is editor and founder of Traders Corner.